In this video, I'm going to show you how to cut your retirement expenses by 20% over the next 12 months without changing the quality of your life. Coming up next on Holy Schmidt.
Holy Schmidt!
I published a research article a few years ago called The Magic of the S-Curve. And the S-Curve basically talks about spending in retirement. And the conclusion of the article was that beyond a certain point, your quality of life doesn't change very much. And spending more doesn't equal more benefit. We're going to talk about that next in the context of this video because it's quite important. Picture making the choice for a week's vacation. Choice 1 is a week in Ventura, California, at a 4-star hotel right on the ocean, filled with activities like snorkeling, parasailing, etc. The second one is a trip similar in the offering, but this time in the south of France. And the third is that same south of France trip, but in the presidential suite. The Ventura trip costs $3,000, the south of France trip $12,000, and the presidential suite $70,000. Which one would you choose? Let's put aside the fact that money may or may not be an issue here for a lot of people, and just ask yourself, do you get 4 times the benefit to go from Ventura, California to the south of France? Because it's 4 times as expensive. And do you get 6 times the benefit upgrading to the presidential suite in the south of France? For most people, the answer is no and no. And most people would choose the Ventura trip if those were their only 3 choices. Of course, there are a lot of choices, but looking at it just from a cost perspective, Ventura would win most of the time. That's the essence of the S-curve. And basically what it says is once your health, safety, and basic needs are taken care of, the additional aspects of your life don't add a lot of value or enjoyment, beyond a certain level anyway. With that in mind, let me show you how to cut your expenses by 15, 20, 25% in the next 12 months. And now you know you may be able to do it relatively painlessly. According to the Bureau of Labor Statistics, the average household whose head is age 65 or older spends about $60,000 per year. Roughly 80% of that lands in just 5 areas. The biggest is housing at 36%, then transportation about 15%, medical about 13%, food about 13%, and entertainment only about 5%. Add those up, and that's how the average retiree spends $4 out of $5. And by the way, this isn't just a government result. JP Morgan had a similar result in JP Morgan's Guide to Retirement. So it's a real number, it's a concrete number. Knowing this is important because when you are in retirement, a lot of people are on a fixed income, and that means that saving that dollar means it's a dollar you don't have to pay taxes on, sell an investment for, or take from somewhere else. A dollar spending cut is worth more than a dollar increase. So if you cut your expenses by 20%, sometimes you get 30% plus in benefit. Next, we're going to walk through each one of those expenses, and I'm going to show you how to cut intelligently in those areas. And for a lot of retirees, these cuts can equal 20% or more. Number 1 is housing. It's the biggest part of most people's budgets, and therefore it deserves the most attention. It's also an area where we may be able to cut the most. Let's start with property taxes because a lot of people don't challenge their property taxes, and they could. Many states offer some form of tax break for older homeowners. This might be an age 65 plus exemption, an assessment freeze that locks in your taxable value, or a circuit breaker credit tied to income. Many jurisdictions also allow homeowners to challenge their assessment if they believe it's inaccurate. And by the way, none of these are automatic. You have to apply, and applying takes time. That's why it fits in a 12-month window. Here's what it can look like. On a home assessed at $400,000 with a 1.5% tax rate, an exemption that shields even $50,000 of value saves you $750 a year, and a successful appeal that lowers the assessment stacks on top. Some states go further and offer additional breaks for veterans or surviving spouses. So it's worth 20 minutes at your assessor's office to see what's available because these cuts continue on year after year. Second, reshop your homeowner's insurance. The reason? Because rates have gone up a lot since 2020. And the fact is, insurance companies have not paid out that much more in claims, and so therefore they're resetting their profit margin. What that means for you, in a lot of cases anyway, is that there might be another insurance company right next door that offers similar coverage, but for less money. And by the way, just so you know, loyalty is expensive. Carriers will often raise rates more on people that they think will never leave than others that will shop. When you do this, don't get one quote, get three. And see what happens when you bundle your insurance, your automobile and your homeowner's insurance together. Because sometimes, because you're giving them more business, they're going to give you a discount. Third, look at your utilities, because a lot of utilities will give you either level pay or they'll give you discounts because there's a 65 plus discount available for certain people. And if you're carrying a mortgage and you're still paying PMI and you paid down more than 20% of the value of that mortgage, you should be able to take off that PMI, and that will save you a bit of money as well. One more quick win: if your taxes and insurance are paid through an escrow account, review that annually, because sometimes they over accrue and you're paying more than you need to pay. Finally, if there's anything you can do to lower your utility bill, consider doing it. Most of the time it's a cheap upgrade. Weather stripping, for example, is a wonderful way to cut your utility bill significantly, and it costs less than $200. Next up, transportation. This is 15% of your budget, and the fastest cut is reshopping your auto insurance, just like we did on the house. You might as well do both, because both can be cut in many cases. First, let me start off with something that I've noticed not only on my insurance, but just about everybody's insurance. The car value continues to go down year after year. If you buy your car 6 years from now, it's going to be worth 20%, maybe 30% of what it was when you purchased it. Yet, the automobile insurance continues to go up every year. At best, it's flat. Why is that? The difference oftentimes is margin for the insurance company. The bigger question is, how many automobiles do you really need? A retired couple often has 2 automobiles because they often do 2 different things, but usually not at the same time. And so, do you really need 2 automobiles? Dropping from 2 cars to 1 removes an entire insurance policy, a registration, the maintenance, and the depreciation. That could be a couple of $1,000s a year before you count what you free up by selling the car. There's also the running cost of a car. Older automobiles are more expensive to run, generally speaking, than newer ones. If you're replacing a car, consider buying one that's pre-owned. The reason is because financial depreciation in a car is a pretty significant downward slope. Actual depreciation is much more gentle. And as we talked about before, check the coverage you're actually paying for. A car that's 6, 7, 8 years old might not have a lot of value left in a collision, but you might be paying a lot more than you need to for that collision part of the insurance. Number 3 is medical, and I'm going to begin by making a statement that will cause a lot of people to scratch their heads, but just stick with me. One afternoon of work can save you a lot of money when it comes to your medical insurance and your medical bills. Let me explain. During Medicare's fall annual enrollment period, that's October 15th through December 7th, you have the opportunity to switch your Part D drug plan or your Medicare Advantage plan. Plans change their drug coverage every year, and a lot of people don't catch it until it's too late. They don't read the notice that they get at the end of September talking about the changes that are coming. The plan that was right for you 2 years ago may not be the plan that's right for you now. Rerunning your prescriptions through a Medicare Plan Finder or a Medicare Advisor often turns up a cheaper plan that covers the exact same prescriptions. And the best part is that starting in 2025, Part D coverage is now capped in your total out-of-pocket. In 2026, it's $2,100. Once you hit that cap, your covered drug costs cost you nothing else for the rest of the year. And one really important part here, your Part D drug coverage has what's called a formulary. If your drug is on the formulary, then the cap applies. If your drug is not on the formulary, it's outside of the formulary, then that's an additional cost beyond the cap. So make sure that your drug or drugs are on the formulary of your Part D drug plan. It's also worth asking whether your whole setup still fits. Medicare Advantage versus original Medicare with a Medigap policy is a bigger decision than the drug plan, and the right answer depends on your doctors and your health. Beyond the plan, look at the drugs themselves and ask your doctor if a generic works as well as the brand name prescription. Gang, speaking of Medicare, Medicare can be confusing. It can be overwhelming. Ask anybody who is age 65 or older and they will tell you that this is true. They'll spend hours of time looking at all of their options. They'll make a choice and find out later that they made the wrong choice, costing them hundreds if not thousands of dollars a year. Now on this channel we have 3 affiliate relationships One is our trusted Medicare Partner Chapter. Chapter is the only national advisor that looks at and recommends every plan. They're totally free to you. Your premium doesn't go up by using them. It takes about 20 minutes of your time, and it saves the average retiree about $1,100 per year. If this is of interest to you, give them a call at 440-703-1224 to see if they can help. Next up, food. The eating out line is the easy one, but also one that you should manage carefully because there's a benefit to eating out, and we'll talk about that in a moment. Food consumes about 13% of the average retiree's spending, and that's split pretty evenly between eating out and groceries. And here's how you look at this. Add up what you spent last month between takeout and delivery and eating out, and see what size that number is. By the way, you don't need to give up eating out. I'm not suggesting that at all. There are a lot of benefits to eating out, but just understanding how you're spending your money will allow you to make better choices because you become aware of how you're spending your money. On groceries, a warehouse club like Costco or Sam's Club will allow you to buy in bulk and a much smaller per item cost. If you do eat out, think about things like loyalty apps and time of day discounts because oftentimes restaurants will charge different prices for different times of day if you're over 65. Food is a smaller overall number than housing or medical, but it's repeated 365 days a year, so it can add up. Number 5, entertainment. It's the fastest fix in the group. It's also the smallest, so the impact isn't going to be as great. Let's talk about it though. Entertainment represents about 5% of the average retiree's spending. Pull up your bank and credit card statements and list every recurring subscription. Streaming services, apps, magazines, the gym, cloud storage, the free trial that started charging you months ago. Almost everybody found 2 or 3 that they forgot to cancel, and they're providing no value whatsoever. After you cancel those, try rotating your subscription services. Don't keep 5 at a time because in reality, when you have a subscription service, at some point you've watched what you want to watch from that subscription service and you move on to the next one, but you forget to cancel the old one. Subscription services renew themselves over time, but there's no reason to keep a subscription to, say, Netflix if you're not going to watch it for the next 6 months. While you're at it, call your phone and internet providers and see if they can lower the rate. There's competition in both, and oftentimes a phone call will yield great results. I call mine at least once a year to see if there's something better. Sometimes there is, sometimes there not, but oftentimes they discover that I was on the wrong plan and I should have been converted months ago. Gang, how prepared are you for retirement really? Many people think they're more prepared than they really are, and the fact is it takes 2 minutes to find out. I prepared the retirement readiness quiz. It's 15 questions, takes 2 minutes to fill out. It's totally free to you, no credit card, no phone number, nothing like that. You simply input your email address, fill out the questions, and a 12-page report will be emailed to you instantly. If this is of interest to you, go to holyschmidt.com/quiz. You'll take the quiz, you'll get your report totally free. You'll also be put on our list and get tips, tricks, and other information 2 or 3 times a week. Now I want to talk about one more that isn't on the list, but it varies depending on who you are, and that's taxes. Up until this point, I talked about 5 categories where people spend 80% of their money, but I have not talked about taxes, with the exception of property taxes, because individual taxes vary so much from 0 for a lot of people to very large for a much smaller number of people. But they are real, and we should talk about them. There's also an additional deduction that you get whether you're itemizing or you're filing the standard deductions that we just talked about. And that's the age 65 plus deduction. That's $6,000 per person if they're over age 65. That deduction begins to phase out if you're single once your modified adjusted gross income hits $75,000. If you're married filing jointly, the number is $150,000. Next, manage the accounts that you draw from because they do matter. Up to 85% of your Social Security benefit becomes taxable once your income exceeds certain thresholds. For a married couple, taxation starts around $32,000 of combined income and reaches a top tier of $44,000. So be thoughtful whether you pull from a taxable account, a traditional IRA, or a Roth account in a given year, because what combination of those 3 accounts you use can change your tax outcome not only this year, but in the years ahead. 2 more moves. If you're 70 and a half or older and you give to charity, A qualified charitable distribution lets you send up to $111,000 a year straight from your IRA. Because it's coming straight out of your IRA, it never gets counted in your taxable income. Finally, in a year where your income is a bit low, consider converting your traditional IRA into a Roth IRA. If you like this video, check out that video. Retirees spend 80% of their income in these 5 areas. Also, don't forget to give Chapter a call if you have questions about Medicare, 440-703-1224. This is Geoff Schmidt, and I will see you in that video right there.